Yeah, yeah. I'm like an addict, do I gotta have it. I ain't even playing, got a really bad habit. If it moves, gotta grab it. Fuse like a magnet, lose won't have it till I'm doomed in a casket. I ain't playing, got a weird mind. If you work 8 hours, I'ma work 9. If the shit tastes sour, you should taste mine. I'ma stay in power for a long time. Get up, nah, I ain't a quitter. Toss me the ball, I'm a really big hitter. Big picture, I'm a straight killer. Passing the song to the highest bidder. Got juice, got gas, I'ma move fast. New shoes, new tracks, like who's that? I'm new, come back, better than last. Yeah, it's a new me, never gonna look back. Never gonna look back. Damn, I'm still blessed. You move slow and I move fast, and that's facts. Only I can make a change. So slowly take a step today. I will never be the same, 'cause that's what it look back, 'cause damn, I was built to last. You move slow and I move fast, and that's facts. Only I can make a change. Slowly take a step today. I will never be the same, 'cause that's what it takes.
All right, y'all. Happy Tuesday, May 5th. We are waiting for the AMC Q1 2026 earnings call to start. I just checked it. They're still playing music, but it will start in just a minute, and they'll do the customary forward-looking statements, rigmarole. And I'm happy to meet you guys and prove that I'm a real person. Someone's having a go at me on Twitter right now saying, Tony, you're just a wannabe suit or an ex-suit. Paid to share your grifting opinion. I'm really not. I'm a guy that got mad at Matt and Trey in 2021, decided to turn on a camera. If I would have known all the dumbasses I would have come across in the last 5 years, I probably never would have done that. But for you guys, the ones who actually want help, I'm glad that we've all got to know each other over the last 5 years. I'm here for you, not for the dumbasses on X. All right, we got the call starting right now. Let's listen in, and while we're listening in, I'm going to be looking through the earnings report also.
Any forward-looking statements, whether as a result of new information or future events. On this webcast, we may reference non-GAAP financial measures such as adjusted EBITDA, constant currency, among others. For a full reconciliation of our non-GAAP measures to GAAP results, please see our earnings release posted in the Investor Relations section of our website earlier this afternoon. After our prepared remarks, there will be a question and answer session. This afternoon's webcast is being recorded, and a replay will be available in the Investor Relations section of our website later today. With that, I'll turn the call over to Adam.
Thank you, John. Good afternoon, everybody, and thank you for joining us today. I am so very pleased to report that AMC achieved our best adjusted EBITDA first quarter result since 2019, pre-pandemic. An adjusted EBITDA improvement of some $96 million year over year during the quarter. It was driven not only by strong domestic performance, but also by vastly improved international results across our European footprint. These results are a clear testament to our disciplined operating execution in maximizing AMC's revenue growth while simultaneously containing our costs, combined with having an unwavering commitment to elevating the moviegoing experience. Our much improved results clearly demonstrate the operating leverage that is inherent in our business, AMC's ability to generate markedly improving results at a time when revenues are rising. Significantly rising revenues, indeed, are our continued expectation for full year 2026. Finally, after repeated flat years, primarily due to the crippling industry strikes of 2023, the box office is back and in a big and powerful way. In the first quarter of 2026, the North American 2% compared to the prior year. The first quarter box office, the strongest since the pandemic closed theaters back in the first quarter of 2020, ended on a high note in late March with Amazon Studios' Project Hail Mary rocketing to become the top grossing movie of the year to that point, and Amazon Studios' highest grossing film ever. But that was just the beginning. The Project Hail Mary box office result was a 2026 record for all of only 12 days because the industry momentum grew even further as the second quarter has started off with 3 more blockbuster hits in a row, with Illumination's The Super Mario Galaxy Movie, Lionsgate and Universal's Michael, and Disney's The Devil Wears Prada 2. There are so many more superb movie titles being released throughout 2026. Rather than regale you with a long list of impressive movies that will be coming out in the remainder of this year, let me just say this. At AMC, we've actually seen footage from the remarkable movies that are set to release. We believe that Disney has hits coming. Movie after movie after movie after movie will delight both our guests and our shareholders. There are both franchise movies and new IP. There are big movie titles in our immediate future, but also medium and smaller titles that also look to have real consumer appeal. We could not be more optimistic about the entire 2026 film slate, especially in the second half of 2026, which we believe will see more continued robust growth, adding up to a record post-pandemic box office for full year 2026. The domestic industry box office so far in 26 is already up about $300 million year over year, and as we look ahead, we think it's easy to forecast that the full year number for 2026 could be somewhere between $500 million and $1.2 billion bigger than that of 2025. If that's not enough, foreign language films in Europe are also doing particularly well, and AMC's improving international performance in Europe so far in 2026 is particularly encouraging. What's crucial about all this industry growth is the operating leverage inherent in AMC. Combining the commercial appeal and outsized performance of so many AMC theaters across the U.S. and Odeon cinemas in Europe, our commanding industry lead in offering premium screens with almost a maniacal focus on reining in our costs. We have repeatedly demonstrated in prior quarters that where there has been significant industry growth with industry revenues rising, then AMC's adjusted EBITDA correspondingly can soar. Turning from our income statement to our balance sheet, ever so importantly, AMC has been actively working to strengthen our balance sheet by enhancing liquidity and improving financial flexibility. As you know, we recently refinanced $400 million of debt that was due in 2027, now extending that maturity by 4 full years to 2031, while simultaneously reducing our annual cash interest expense in the process. We are also currently converting some $155 million of our debt into equity as we speak. To bolster cash reserves, we raised approximately $72 million of gross proceeds in the first quarter through our at-the-market equity program. And also during the first quarter, we also opportunistically sold a portion of our holdings in Hycroft Mining at an average price of $42.40 per share, realizing approximately $30 million in cash proceeds. When combined with our prior sale of Hycroft shares and warrants in the fourth quarter of 2025, AMC has now generated approximately $54 million of cash from the sale of Hycroft shares and warrants, well north of our initial total of $27.9 million invested in Hycroft. In addition, AMC continues to retain approximately 129.5 thousand Hycroft shares to participate in potential future upside at Hycroft. Taking all these actions together, from balance sheet item after balance sheet item after balance sheet item, AMC obviously has been vigorous in addressing the need to further right our balance sheet. With that, I'll turn the call over to Sean Goodman, our CFO, who will walk you through our financial results in Q1 in more detail. I'll then return afterwards to provide some additional, and I might add, very important updates. Sean?
Thank you, Adam, and good afternoon, everyone. The first quarter box office was indeed the strongest start to a year in 7 years, as we welcomed 47.6 million guests to our theaters across the globe. This represented a 13.6% increase over last year. The operating leverage in our business, when coupled with growth in our per-patron performance metrics and operating efficiency, resulted in first quarter adjusted EBITDA growth of $96 million and the achievement of a post-pandemic first quarter adjusted EBITDA record of $38.3 million. In Q1, we set per-patron records in admissions revenue, food and beverage revenue, and total revenue in both our domestic and international businesses, and we exceeded $1 billion in consolidated Q1 revenue for the first time since 2019. Our consolidated contribution margin per patron, which is representative of the profit generated per incremental guest, grew 6% over last year to a record of $15.19. This measure is now 57% higher than the first quarter of pre-pandemic 2019, underscoring the meaningful improvements in the business over the last few years. This is why the box office does not need to fully recover to pre-pandemic levels for us to be able to achieve pre-pandemic levels of adjusted EBITDA. Domestic total revenue per patron is now up 53% versus Q1 of pre-pandemic 2019, and domestic contribution margin per patron is up 67% compared to Q1 of pre-pandemic 2019. When reviewing our international operations, you should note that Q1 2026 results were impacted by a year-over-year increase in foreign currency exchange rates of approximately 10.8%. International revenue per patron is now up 34.5% or 31.4% in constant currency versus Q1 of pre-pandemic 2019, and international contribution margin per patron is up 38.6% or 35.4% in constant currency compared to Q1 of pre-pandemic 2019. Our results for the quarter reflect the box office growth combined with the impact of strong performance from our innovative loyalty programs, success with our pricing strategies, leadership in premium large formats, continued enhancements to our food and beverage offerings, disciplined operating efficiency, and ongoing optimization of our theater portfolio. We continue to actively reshape our theater footprint by investing in facility upgrades, proactively securing improved lease terms, closing underperforming locations, and selectively adding theaters to meaningfully strengthen the overall quality and profitability of our circuit. During the first quarter, we closed 5 locations and opened 1, and since 2020, we have now closed 218 locations and opened 66 for a net reduction of 152 theaters, or approximately 15% of our portfolio. Looking at the balance sheet, we ended the first quarter with $339 million of cash, excluding $42 million of restricted cash. As previously noted, our working capital cycle follows box office seasonality. Typically, we generate cash in the second and fourth quarters, and we use cash in the first and third quarters, with the largest outflow occurring in the first quarter. This pattern held true for the first quarter of 2026, contributing to our cash burn. Balance sheet strength continues to be a priority, with a focus on maintaining liquidity, extending maturities, lowering borrowing costs, and reducing debt and leverage, while still continuing to invest in our core business to enhance the moviegoing experience. To that end, as Adam noted, this quarter we successfully raised approximately $101 million through our at-the-market equity offering, plus the sale of Hycroft shares. The capital raised is being used to both strengthen the balance sheet and invest in initiatives that elevate and differentiate the guest experience. Following the successful refinancing of $400 million of 12.75% debt maturing in 2027, with a new $425 million first lien term loan at 10.5% that is due in 2031, our sole remaining debt maturity prior to 2029 is $125.5 million of 6.25% unsecured notes, which mature in 2027. And of course, our balance sheet is further strengthened by the announcement earlier today that approximately $155.8 million of senior secured exchangeable notes due in 2030 are converting into equity. Yet another step along our path to reduce debt and improve financial leverage. From a capital expenditure standpoint, CapEx net of lease incentives was $28.4 million in the quarter, and our 2026 CapEx guidance remains the same, between $175 and $225 million net of lease incentives. So in summary, the first quarter reflects a very strong start to the year, with growth in attendance, coupled with record per patron revenue and per patron profit, driving significant improvement in adjusted EBITDA. All of this positions us very well as we move into what we expect to be an increasingly robust box office environment as we progress through 2026. And with that, I'll turn the call back over to Adam.
Thank you, Sean. Before we go to your questions, I want to briefly address 5 key topics that are important indicators of the progress being made at AMC.
Here we go in the Discord.
First,
get your drinks ready.
The
Bingo time.
2026 film slate is bigger, bolder, deeper, and more visually spectacular than what we've seen in many years. These are exactly the kinds of films that demand to be seen on the big screen in premium large format auditoriums, such as AMC's 225 IMAX at AMC auditoriums, our 181 Dolby Cinema at AMC screens, our 8 ScreenX at AMC and 2 4DX at AMC screens, along with our house brand 47 Prime at AMC screens in the U.S. and 83 iSense auditoriums at Odeon across Europe. They all join our 3,543 laser at AMC equipped screens and our 168 XL screens across the world. I'm giving you these numbers to remind you of the salient fact that no one has more premium screens than AMC. And with the AMC Go plan, we are not standing still on these quantities. We are yet again still significantly expanding the number of our premium offerings and adding even more laser projection technology. We also will be looking to increase the number of theaters, especially in the United States, that offer our far more comfortable branded AMC Club Rockers seats, which have been the secret of our success at 3 notable theaters, Empire in Lincoln Square in Manhattan and Burbank in the Los Angeles market, which continually rank week after week as being among the absolute highest grossing theaters in the entire country. We think they owe much of their success to the Club Rocker seats, and we will be taking these Club Rockers to many more of our high potential theaters. Second, speaking of our commitment to innovation, since 2023, with AMC's sensational partnership with Taylor Swift, AMC has gotten more and more involved in bringing musical artists in some shape or form to theaters. Taylor and Beyonce, and Usher, and Billie Eilish, and Nicole Scherzinger are just some of the musical greats who have graced AMC screens, either with concert films or album release celebrations. Today, I am especially excited to unveil something that is brand new to you all, that AMC will be taking music to a whole new level. We are announcing today a wholly new product line, Arena One at AMC. Starting this June, right around the corner, AMC theaters will offer a truly groundbreaking shared live concert experience from day one across more than 300 AMC theater locations in 89 markets nationwide. Arena One at AMC will deliver exclusive, real-time, interactive, live concerts where our artists will perform live from a purpose-built stage and engage directly with audiences inside our theaters across the country. This is a highly immersive communal experience combining the energy of a live concert with the scale, comfort, accessibility, and affordability unique to AMC. We believe that this innovation can open an entirely new chapter in live entertainment while driving incremental attendance and revenue across our circuit. Fascinatingly, with our Arena One at AMC experience, it is a two-way experience between the artist in a live stage remotely and the concert goers all across the country in our various Arena One at AMC equipped auditoriums. We are also excited to say that for the immediate future, this is an exclusive AMC offering. Arena One will only be available at AMC. Only available, that is, until we launch in the United States in June, because shortly thereafter, we will be taking Arena One at AMC also to some 260 Odeon theaters in 9 countries in Europe as well. This new live concert experience is an initiative that represents a major announcement by AMC Entertainment. The third topic for today, I also want to address the rapid developments of late as to exclusive theatrical windows. The momentum in the industry is palpable, with renewed commitments by our studio partners to both increase the number of theatrical movie releases and to extend theatrical windows to at least 45 days. Joining Disney, which has been constant in respecting an exclusive theatrical window heretofore, we are particularly pleased by the recent announcements by Universal and Paramount to do the same. We are appreciative of the public commentary by Sony and Lionsgate that a new industry standard is both needed and is emerging. Recognizing Paramount's commitment in this area, for example, this was one of the key reasons why we at AMC embraced Paramount's bid to move forward with its proposed Warner Brothers transaction. This is such good news for the movie theater industry, and we are pleased that AMC has played a central role in pushing this entire initiative of respecting longer theatrical windows forward. But the real heroes here supporting our industry, especially on this Windows topic, are the people who have really stepped up. Alan Bergman at Disney, Donna Langley at Universal, Tom Rothman at Sony, David Ellison at Paramount now, and eventually on behalf of Warner, and Adam Fogelson at Lionsgate, all deserve praise for having a long-term view of restoring the health of our entire theatrical ecosystem. The fourth topic for today, the significance cannot be lost by anyone of Netflix's announcement that in February of 2027, just 9 months from now, it will be giving Greta Gerwig's Narnia a global theatrical release with a 49-day window. This is the biggest opportunity our industry has ever had to embrace Netflix as a theatrical content provider. Since our announcement at AMC in October 2025 that AMC and Netflix would be working cooperatively and collaboratively, we've had several joint projects which have been immensely successful for both companies. Netflix is well aware that AMC is solidly in their corner. We are all in with respect to Narnia, and we enthusiastically will continue to seek more opportunity for our two great companies to work together in the future. And finally, fifth, it is so encouraging to remind you all that in just the past few weeks, film producers have reached multi-year labor agreements with both SAG-AFTRA and the Writers Guild, assuring us all of labor peace for several years ahead. This means that the self-inflicted wounds of 2023 are not being repeated. To be sure, as we have said so often before, at AMC we're not entirely out of the woods yet. Challenges remain, but the indicators that we're seeing today point to a stronger and improving 2026. Indeed, it seems to us that so much has been breaking our way of late. And remember, above all else, two words: operating leverage. As revenues grow, which we believe they will, there's a very significant impact on AMC's bottom line financial performance. With that, let's turn the call over to our operator to poll for questions, both from equity research analysts, and Sean will also give me some of the questions that have been submitted by our retail shareholders.
Thank you. If you'd like to ask a question, press star 1 on your keypad now. To leave the queue at any time, please press star 2. Once again, that is star 1 to ask a question, and we'll pause for just a moment to allow everyone a chance to join the queue. Thank you. Our first question is with Eric Wold with Texas Capital. Please go ahead. Your line is open.
Thanks. Good afternoon. A couple questions. I guess first off on Arena One, not sure how much more you can share about briefly about the economics behind this and technology spend required. Is this the purpose-built stage something that you will own and be responsible for? Is this something that eventually will go more widespread? And is this geared towards artists currently on tour, looking to reach markets where they're not going physically, or is it something that's kind of more for artists kind of doing this as one-off performances?
Thank you, Eric. I'm happy to comment. There is a separate press release going out about Arena One, sort of concurrent with this call, so you'll get more detail. We really are blown away by the technology where the artists performing in this purpose-built stage can actually interact with our audiences all around the country and eventually in Europe. The business proposition is so appealing. As you know, we've done a lot of things with even as we shaved down our capital expenditure program, and we were able to get Arena One implemented with essentially no upfront spending by AMC. The economics are, this is a rev share model where AMC will retain a significant percentage of the admissions revenue and the food and beverage revenue that occurs in our theaters. And Arena One will also get a significant percentage of the ticket revenue that we generate. For concerts, these things will be cheap, but they're not going to be priced at movie theater levels. The prices will vary by artist and by market, but I wouldn't be surprised if we see ticket prices in the $40 to $75 range. As I said, that's very inexpensive when you look at what it costs to actually attend a live concert in an arena or a sports stadium. Another benefit of the Arena One experience, unlike when you see a live concert in a large 20,000 seat arena or a 70,000 foot stadium, it feels to you like you're sitting in the front row because like the artist is right in front of you. So the product is great for consumers. The economics are favorable both to Arena One and for us. And in terms of the artists who do it, we think we'll see whole sets of artists who'll come to our studio. There's a massive complex in eastern Pennsylvania who will perform specifically for the Arena One audience. We're creating in the neighborhood of 250,000 seats available to Arena One concert ticket buyers if you add in our U.S. and European theaters. This is a very exciting initiative, and that we got this done as an exclusive for the foreseeable future. That makes it just that much better for us.
Perfect. Thank you. And then just my follow-up question, kind of going back to the contribution margin per patron and kind of the growth you've experienced since pre-pandemic. I think I got the numbers right, 57% in the U.S. and 39% international. And kind of those FX or not, but maybe talk about your thoughts on closing that gap overseas, the opportunity to do that, maybe what's been holding back the growth there, or maybe say a different way, what's been driving the stronger growth here versus overseas, and where are you with various ticketing and concession strategies overseas that could kind of help to close that gap in the coming years?
Well, both Sean and I will take this question. Historically, our guests in our European theaters spend less on non-ticket type purchases in the buildings. So it's not surprising to me that our U.S. performance would be higher than our European performance. But we think that both numbers are great. The fact that we were able to drive up per patron contribution by so much in the U.S. and so much in Europe, we think they're both items of success. You want to add anything?
Yeah, I think the U.S. has benefited from two areas that are a little bit different to the international business. The first is the U.S. business has benefited from the renegotiation of our screen advertising contract with National Cinemedia. So that has helped our other revenue per patron. You don't see that sort of impact in the international business. The second is when you look at food and beverage, which is obviously a huge driver of this area, the U.S. is a little more ahead in terms of merchandising food and beverage revenue with the popcorn collectible concessions. Europe is catching up in that area, and I think you saw this last quarter, Q1, look at the European person growth rate. It's quite phenomenal, actually, like in excess of 6%, and that's in constant currency. I think it's over 18% outside of constant currency. So you're seeing some catch up in Europe, which is pretty exciting. And then I think there's an opportunity, from an average ticket price point of view, we have had more competition on ticket pricing in Europe, but that is starting to normalize. So we've seen some benefits there, and you're going to see more variable type of pricing in Europe where it is more accepted than in the U.S. market. And I think that gives us opportunities in Europe as well.
And while we're talking about Europe, Eric, I just want to say that the first 4 months of the year, the first quarter that's reported and what we've seen with these successful movies in April, Europe's been gangbusters successful for AMC this year. Like we've been blowing through our budgets in Europe week after week, month after month. We're so encouraged by our strong performance across our European network. Next question, operator.
Thank you.
Thank you. We'll take our next question from Mike Hickey with StoneX. Your line is open.
Hey, Adam, Sean, John, great quarter, guys. Congratulations. First question from us, Adam. A lot of wins for you, a lot of progress from you and your team here. Looking at the window situation, I guess that's a win for the whole industry. Strong box office. Your debt situation has improved dramatically. A lot of work on your guys' part. You've optimized your network. You've been innovative with Arena One, and you stay disciplined on CapEx. So, Adam, I guess the question is, if you can sort of give us an update on your path to free cash flow, milestones, maybe timing. And then the follow-up would be thinking about Arena One here, depending on how you think you can scale it, if that will sort of lower maybe that box office target that you would need to get to be free cash flow positive. Follow-up.
So I'll let Sean talk about free cash flow positive and milestones like along the like. But I want to just point out one thing to everybody. Mike, it's nice of you to list the sort of our getting things done on the to-do list. You know, we put a lot of personal capital into play to convince studios to lengthen windows. Our cooperating with Netflix has been a major change. As I said on the call, things really seem to have been breaking our way of late. But I just want to talk about the balance sheet for just a second. I would remind everybody that in the quarter we are just completed, especially with this $155 million debt to equity conversion that was announced this morning, that lowers our long-term debt to about $3.9 billion. Our debt going into COVID was over $5 billion. And when you added in all the deferred rent obligations that we picked up in the closed year of 2020, by the time we ended 2020, we had over $6 billion of either actual long-term debt or deferred theater lease obligations. That we've gotten rid of a third of it is, especially in a suboptimal box office environment the past several years, we think is just a superb accomplishment. And we obviously have been paying attention to driving our income as best we can and to improving our balance sheet as best we can. And as we look back on the last crazy 6 years that the good Lord threw our way with COVID and its aftermath, we're very proud of what we've accomplished at this company. As for free cash flow milestones, Sean?
Yeah, thanks, Adam. We are very focused on taking steps each day, really, to reduce the level of box office required for us to be free cash flow break even or free cash flow positive. And if one looks back to pre-pandemic, the box office required to be free cash flow positive was significantly, very significantly higher than it is today. And that's despite the fact that 6-7 years have passed, costs have increased significantly. Our debt services costs are also significantly higher than they were pre-pandemic as well. So that just gives you an indication of what has happened in the business to reduce the required box office to be free cash flow break even. And I said in my prepared remarks, and I've said it a number of times, that we don't need the box office to get to pre-pandemic levels to reach the same level of EBITDA as we had pre-pandemic. And that is certainly the case as our profit and contribution margin per patron improves over time. A reference point that one can look at to get an indication of where we are from a box office / free cash flow perspective is look at the last 9 months of 2025. Last 9 months of 2025, we were not only free cash flow break even, we were free cash flow positive. Now there are some working capital benefits in that period of time that you can adjust for. But that just gives you an indication of where the business is at the moment. And I'll add one other thing, is that as the box office improves, automatically our interest rate on about $2.9 billion of debt reduces, because inherent in the covenants or debt agreements that we have there is that the coupon or interest on that debt declines as our leverage improves. So that will help us as well.
And Mike, to your question about Arena One, we know the technology works, and we know the economics work, because our investment was upfront was like non-existent, and it's a revenue share basis, which is sort of the whole model of our industry with studio partners. I think that what will determine when we know that Americans and Europeans like to go to concerts, and we know that they pay up for it. So I think ultimately the real success of Arena One will be based on what artists we attract to have these live concert events that are broadcast to 600-ish theaters in the U.S. and Europe. But we're quite optimistic, and as we said, we believe this is going to be a very profitable activity for us, and one that we have on an exclusive basis, and one that we think has a great potential opportunity to deliver real dollars to the bottom line.
Thanks, guys. The second question from us is on film volume. CinemaCon, obviously a lot of action this year, Adam, with the Paramount Warner Brothers deal. David, I think, made a really compassionate pitch to you and your peer set exhibitors at the conference, really sort of committing to that 30 films and 45-day window. But there also seems to be a healthy amount of skepticism just from history, I guess, on their ability to execute on the 30 films. So just curious if you could sort of frame that for us. I'm guessing if they got close, it would be a win, but curious your view on their ability when you talk to David for them to deliver on that promise. And then on Netflix, just sort of trying, it's obviously very exciting, and but also I think there's some pushback. Maybe this is just a one-off led by Greta. So just wondering, when you talk to Netflix and Ted, the appetite you see from them in terms of putting additional films into exhibition, and if you think that this sort of 51-day window to streaming is a workable model for other films in the future as well. Thanks, guys.
So let me talk about Paramount first. We've had private conversations with Paramount for months and months at the highest levels, and what you described is the sort of passionate commitment that David made at CinemaCon in front of 5,000 people in the auditorium. He and the people who work for him made those same commitments to AMC privately in the days, weeks, and months previously, and we believe him. We have great respect for the leadership at Paramount. I might add, just like we have great respect for the leadership team at Warner, they had a sensational year in 2025. And we strongly hope that the filmmakers at Warner stay, because they're great. And we have enormous confidence and trust in the leadership under David at Paramount. And we believe that he is fully committed to the promises that he made and fully capable of pulling them off. As for Netflix, again, there's been a tremendous amount of top-to-top diplomacy between the two companies that dating back to the fall of 2025. At AMC, we were very pleased to have participated in 3 projects with Netflix. The K-pop Bring Back at Halloween, the Stranger Things season finale at New Year's Eve, and the introduction of new episodes of One Piece just a couple of months back. The success of those 3, I think, is one of the reasons, not the only reason, but one of the reasons that Netflix is trying to see what happens with Narnia. I believe that the 3 things that we've done already with Netflix have been successful, that Narnia will be successful, that we will find other successful opportunities to work with Netflix. And what this leads to, I'll leave you all to speculate amongst yourselves. It's not my place to sort out what or announce what is or is not Netflix's strategy. But I can tell you that the interpersonal dynamics that have existed between Netflix and AMC since September of 2025 have been very positive. And both companies have said repeatedly, both publicly and privately, that we are looking to do more together.
Awesome. Thank you, guys. Good luck.
Thank you. We'll move on to Brad Bainon with Macquarie. Your line is open.
Hi, good afternoon. This is Chad from Macquarie. Wanted to ask about the merchandising opportunities.
I thought it was your cousin Brad.
Alter ego. It's after 5 o'clock. Thinking about the merchandising opportunities, Adam, I know you talked about this business, which kind of went from nothing, was on its way to approach $100 million in 25. It seems like based on, just looking at the titles and the content throughout the year, this should be another big merchandising year. But wondering if you could help us think about kind of what you have in store and how this business can continue to grow as more people come out to the theaters. Thank you.
Well, if you judge by the number of people who wanted Prada purse popcorn bags, there is no end to the consumer's desire to have more movie-themed merchandise at our theaters. I think that we are fully capable of driving 20% growth per annum in this merchandise business. And that's before Arena One. And we also know that merchandise is very popular amongst live concert goers. So as you said, Chad, in 2022, our revenues were like nothing. And it's a $100 million a year business for AMC currently, and it's going to continue to grow.
Okay. And then just in terms of the convert, what the thinking was to strike that now, given where the balance sheet is and the outlook. I know there's always working capital shifts. Sean, you talked about that. But what was the reasoning for executing the convert deal this week? Thank you.
Yeah, Chad, in terms of the agreement for that exchange note, there is a mandatory conversion provision based on our share price. So our share price achieved the targets for the mandatory convert, and therefore we were able to convert that debt into equity. The benefit of this, of course, is it takes $155.8 million of debt off the balance sheet. There were also various covenants associated with that debt, that with assets no longer being on the balance sheet, it frees us up to be even more opportunistic going forward in terms of refinancing opportunities that we may have. And given, just a little aside on that, given the refinancing of the $400 million of Odeon debt due in 2027, we now can be completely opportunistic in terms of taking advantage of lower interest rates and extending maturities when those opportunities arise. We're not forced into a situation of having to refinance based on a coming up maturity.
And Chad, when you remember how much of our debt was due in 2026 or 2027, we've moved to around $3 billion to a maturity in 2031, and there or 29 or 31, I should say, and we have a sizable amount of debt that's currently due in 29, which is a long time from now. But we do believe that as AMC's, well, let me just go back to operating leverage. If the box office is going to grow, then AMC's EBITDA is going to grow. If our EBITDA grows, by definition, our leverage levels fall. If our leverage levels fall, we ought to be able to refinance some, even our 29 debt at significantly lower interest rates and push their maturity out further. So I do think our management of our balance sheet has been one of our most important success stories of the past few years.
Thank you both. Best of luck.
Thank you.
Thank you. We'll move on to Patrick Scholl with Barrington Research. Your line is open.
Hi, thanks for taking the question. You provided a lot of detail on the screen base. I was wondering if you could provide just a little bit more on just where you think you are in that process of kind of right-sizing the footprint for profitability. Thank you.
Yes. I think the press has misunderstood some of the comments we've been making. I saw articles after the last quarterly earnings call that AMC was, quote, closing theaters. That's not the way to look at this. The way to look at this is AMC will constantly be pruning the fleet, which is to say that about 10% of our leases come up for renewal every single year. So when we look at those theaters, some number of them are huge home run winners. Some number of them could be more profitable if we could renegotiate rents with theater landlords. And some number of them are just like older buildings that are now 20, 30 years old. They may not be in ideal locations. They might have been in ideal locations when they were built 25 years ago, but not today. And so it makes sense to let them go. At the same time, we are also adding new theaters. And I mean, I would point out that the 60 theaters that these are round numbers, the 60 theaters that we opened in the last several years outgrossed the 200 theaters that we closed. So I don't see this as like what's the right size of our footprint. I think that this is a perpetual business strategy that as our theaters come up for renewal consideration every single year, we're going to be thrilled to renew some. We're going to talk hard with landlords with others, and we'll close others. At the same time all that's going on, we'll continue to look for either more new build theaters or more spot acquisitions where we can add theaters to our footprint that we think are economically attractive to do so. You know, think of it as You know, you open shiny new theaters and you close older, more tired ones. I think that's something that we'll do year in and year out for years, if not decades, to come.
Okay. And then just on the shift in windows, do you think there's any sort of like consumer relearning that needs to happen, which is like the longer windows, or how do you kind of like expect that to sort of ultimately impact like either the tail of box office or just overall box office?
Without attributing it to the studio executive who said it, I was at a industry-wide conference a few weeks ago, and the head of one of the major studios said that we are going to retrain the consumer that movies will be in theaters longer and the movies will be going to the home at a slower pace. And there are actually two windows to pay attention to, not one. We all talk about the 45-day window as a shorthand, but there are two windows. The first is the so-called PVOD window, the premium video on-demand window, which is when movies go to the home where consumers can pay to watch that movie. Often those movies are priced at $20 for a home viewing. But also, the same studios who've been committing to a 45-day window, many of them have also committed to a 90-day SVOD window, or subscription video on demand window. And that's when, not when the movies go to the home where people pay for it to watch it, but it goes in subscription services where once you've paid your monthly membership fee up front, the cost of an incremental movie is zero. And in the minds of many consumers, they're paying nothing to watch a movie at home. It's just as important to us that the 90-day window go into play because it's giving the opportunity for theater operators, AMC included, to convey a sense to the consumers that if you want to be part of this global phenomenon of seeing a movie when it's hot, you got to do it in the theater. You can't wait till it comes to the home. And that's something that's quite different than movies going to the home at 17 or 21 or 25 days after initial release.
Okay, thank you.
Thank you. At this time, I'd be happy to return the call to Sean Goodman.
Thanks, operator. Adam, given the time, we'll just address one or two of the retail questions. But the first question here, very high-level, broad question about we have a lot of growth opportunities, and there's a lot of things we talk about. It's a question to sort of prioritize. What are the key growth areas that you're focused on?
There are so many. There's so much opportunity within this company because of the operating leverage that I talked to in the call. As our revenues rise, our EBITDA rises at a faster pace. And what we've been fighting for the last 3 years is that revenues have been, for the industry, have been flat. That seems to be changing fairly dramatically in 2026. We're looking, of course, at just the fact that there are more films coming out with bigger consumer appeal, where we can attract more guests to our theaters, which means you can sell them more food and drink, and we can introduce merchandise that we have over the past couple of years. One of the things that we have obviously noticed is that our premium large format screens command higher prices and sell first. Just the other day, when Michael came out, 10%, approximately 48% of our revenues for Michael opening weekend took place on premium large format screens, even though premium large format screens are only less than 10% of the total screen count. Like, these are stunning numbers. So we've obviously already figured out ways to significantly increase the number of premium large format screens. We created XL extra large screens out of thin air, out of whole cloth 2 years ago, and we now have 168 of them. I would not be surprised if we don't double that count of XL screens by the end of next year. There's also the opportunity, I believe, as I mentioned on our call, to put in better seating at some of our most productive theaters. These new Club Rocker seats that we put in at Empire and Lincoln Square at Burbank, they are not recliner seats, so we don't have the 40% seat loss that we have when we put in recliners, but they're wider, they're much more comfortable. Guests love them. And we've already identified 30 of our highest grossing theaters where we could put these seats in at pretty inexpensive capital costs, because you don't have to renovate the whole theater or build new platforms. You're just putting in new seats themselves. So on and on, it's sort of opportunity after opportunity after opportunity. I also think there's opportunity to make our marketing programs even more potent than they are today. As many of you know, A-List is a smash hit, especially among Gen Z moviegoers. We just, in the last week, crossed 1 million people who are members of our A-List program. Our Stubs program, which is our loyalty program, which has 39 million member households. It only had 2 million member households when I joined this company 10 years ago. Stubs is a smash hit program for us. There are some evolutions in the Stubs program that we think we can introduce later in 2026 that will appeal to people going to see, let's call it 6 to 15 movies a year, which is a slightly different audience than our A-List crowd, who tends on average to see more like 30 movies a year. So there's so much opportunity for this company. And not the least is there's pricing power in this business. And there's pricing power both ways. The fact that people are willing to pay more and that has been the case traditionally, to see movies in our premium large format and extra large format screens, that's encouraging. I'll also tell you that in July of last year, we significantly upped our game by introducing Discount Wednesdays in addition to Discount Tuesdays, rebranding both as 50% off Tuesdays and Wednesdays. That's been a major positive for AMC. So it's an example where taking prices down has actually worked for our company as well. In the interest of time, we're over an hour, and that answer to that last question sort of touched on a lot of things that you might have asked me, Sean. So I think at this point, we're going to let everyone run from this call. We thank you much. This was a great quarter for AMC, the first quarter of 2026. It was our best quarterly results for the first quarter in 7 years. Our EBITDA was up $96 million year over year, quarter to quarter. And it reminds us all how much operating leverage there is in this business. If revenues rise, which we believe firmly that they will, knowing the movie slate that's coming for the rest of this year, it's a very good news story for AMC going forward. Thank you for joining us today, one and all.
Thank you. This brings us to the end of today's meeting. We appreciate your time.
All right, I'm trying to bring up my spreadsheet, but I accidentally closed the the tab. I just want to do a quick comparison to the income statement, not this. This. Oh, here it is. It's still there. I'll do a recap video. Going over how we did compared to what I forecast. You know, I have my low, medium, high forecast for the quarter on revenue and net income or loss. This result here, 1.045 billion, is actually better than my highest forecast, low, medium, high. They did better than even my best estimate for Q1. So that is good. Emissions, I had 554, it was 578. Food and beverage, I had 346. They came in at 347. I mean, that's pretty good for a non-suit, non-paid retail trader like me to get within 1 million on food and beverage. Come on. Other, which includes merch and stuff, they brought in 119, and I had estimated 105. So they did a little bit better on admissions and merch than I was anticipating. Another thing that I've really been trying to forecast, which I didn't worry about too much. You don't normally need to worry about it too much when a company's debt is very fixed. You know what the interest payment is going to be every quarter, but AMC, it's never that easy, right? They're constantly redoing the debt, increasing the interest rates, decreasing the interest rates, whatever they are. So I have been trying for a year now to forecast what the interest expense is going to be. And I have a spreadsheet where I calculate all of that. I had estimated that it was going to be 116, and it was 119. For not having access to their books, I think that's pretty good. And as you can see, a year ago, it was 109. So all these other people out there telling you over and over, interest expenses going down. No, it is not going down. It might go down this year. It might go down in future quarters, but it's only been going up because the effective interest rates AMC keeps getting in their renegotiations are not favorable to the company. But maybe we've turned the corner here in Q1. Maybe we turned the corner. I'll let you know in the next video what I'm forecasting for interest expense next quarter. What else we got here? Operating loss 45 million. Well, look at that. I had forecast operating loss 45 million. I mean, come on, guys. Give me a little credit. Look at this, 45 million. I had forecast 45.6. The actual operating loss was 45.7. Net loss 117 was the actual, and my net loss forecast was 142. So I over forecast something here. There are a lot of things we have to guess on, like other. We got to guess on mostly other. Depreciation I had at 52, and it came in at 75. So other income 52. And I had 40. You know, some of these things we do our best guess. and I had to factor in the Hycroft thing and a bunch of other shit. So we were pretty close. 142 is what I was expecting. 117 is the actual. I like to have the company beat my forecast. I try and be realistic. I try and be conservative. And if they do better, that is a bonus for myself. Like if I'm making a trade based on a conservative forecast and they beat it, then that is generally good news. What I don't want to do is hopium up the numbers, fool myself, fool you, make a trade, and then they have a bag of rocks on the numbers and we all get hosed. That does not do anybody any good. So I do my best to give you guys realistic numbers, even though a lot of people like to complain about them. Baby UFO says, do you think the forecast may enable actual reduction in the debt this year? We just got 155 million off the balance sheet today. I'm not anticipating any other debt being paid off. Let's look at the debt tab real quick. What do we got coming up? Next debt is not due until 2027. I would not expect any further debt reduction off the balance sheet this year unless they had so much free cash flow that they paid off some of the debt. I mean, it's possible, but I'm not counting on that. Or they do another debt for equity swap, trade some shares for debt, but they're running out of shares. So I'm also not expecting that. You know, they only have like 200 million shares left. So options, or they're running out of options. They're running out of capability to do much. The next shareholder meeting is scheduled for September. That's probably going to be a date for us to be paying attention to, because as the company, you know what I always say, when do you need to pay the most attention? When they're running out of cash and when they're running out of shares. So I will be, we might be talking about this as we get closer to September. What is going to be on that proxy? And we should get that, what, late July. Are they going to ask for more shares? Are they going to reverse split to free up shares from authorized? I don't know. I do know they're running low, and the CFO's hands are tied on reducing debt if he doesn't have shares to work with. I'd prefer they don't use shares for anything, right? I'm sure all of you would too. But the alternative is we must have positive free cash flow to chip away at that debt. You could have $4 billion of debt on the balance sheet for the next 30 years. That is not the problem. They can keep pushing that debt as long as they're making money. The problem is negative annual free cash flow, losing money in Q1 and not making that much money back in Q2 through Q4. So we got to grow the box office. We must improve free cash flow to a positive annual number. Saying the last 3 quarters are positive free cash flow is not good enough. It must be on an annual basis. Then you can get out of this trap of constant dilution just to not file Chapter 11. So it all comes down to what? Go see some damn movies. If you're not supporting the company by going to movies, you're protesting, all you're doing is shooting yourself in your foot. I get it. If you don't like movies, don't go see them. I'm not telling you to go waste money on something you don't enjoy, but that is the only way out of this mess, box office. And AMC doesn't control the movies, the studios do. So there is some positives there. We have Netflix wanting to play ball, maybe. We've got studios saying they're going to increase the theatrical window. And we have now this new Arena One where maybe there's going to be some more concerts. I'm curious to see how that goes. Anything they can do to increase revenue, and all of those things are potential ways to do it. Fatboy Slim Dan says we need to see what leases are up. I mean, that is another way they can cut cost, and they continue to get rid of money losing locations. But I think the average lease across the fleet is 8 years. That means only a few theaters come up for throwing overboard every year. I mean, it's you can't just break a lease. So even if they're losing money on it, they got to tough it out. Leroy says, what do you mean by running out of shares? There are 1.1 billion shares authorized that they can issue, Leroy. That is the maximum after the December vote that just happened. And of those 1.1 billion, about 800 and what did I say? I tweeted it out or put it in Discord today. 800 and something million are either issued or reserved for compensation or other exchangeable notes. So only 200 million and change left of shares. Those would be, normally you would want a company not to use shares, right? You'd want them to buy back shares. But AMC doesn't have the luxury of cash sitting around to buy back shares. They're trying to pay off debt and stay liquid, avoid Chapter 11. So they're using shares to raise money or pay off debt. That's just the situation. This is nothing that any money-losing company doesn't struggle with. And that is the company you're invested in. So I have been telling you guys for 3 years now, I only swing trade this company. This is not a hold. This is a high risk of dilution trade. There could be price volatility. Absolutely. If you got in at $1.97 like some of us did, you just had a chance to double your money. There might be more opportunities like that this year. But into any run-up, AMC is going to try and sell shares or swap debt for equity. So at some point, that will cap any run-up. They have to fix the balance sheet. They don't hate you. They're not trying to make you lose all your money. You invested in a company with a upside down balance sheet. That's what you're holding. There are more liabilities than assets. When you heard Sean and Adam talking about leverage ratios, when your balance sheet is upside down, the leverage ratios are effed. And that doesn't go over very well. Institutions will avoid your stock. Your stock price is going to be shorted. So they must continue to repair the balance sheet. You should expect more dilution unless there's massive profits, hundreds and hundreds of millions of free cash flow, which they could use to chip away at debt if it ever gets to that point. I don't know. I got to look at the free cash flow for Q1. I was anticipating that it was going to be between negative 200 to negative 300 million, and it came in better. Came in at negative 174, so that is good. Like I said, I had a late lunch today, so I did not really get a chance to look at any of the numbers before this earnings call. So I will do that this evening and look for all the hidden little gotchas. What did they sneak in? How did Hycroft affect the cash balance? All of the little things, the accounting notes that may not be apparent at first glance. I'll look for all of that tonight or tomorrow as I have free time, and then in the next day or so, I'll put out a recap video. In general, I'm bullish about the rest of the year for the industry, Q2 through Q4. We got the actors and writers strike out of the way. That was huge. We've got an update finally on the equity offering today. They've sold, I think, what did he say? Something like 70 million shares. That is still out there. They're going to keep selling shares till they've raised 150 million. Oops, dropped my empty mug. But I don't know. I mean, I don't know what they could stretch that ATM offering out as long as they want. As long as they don't need cash, there's no reason to rush it. So I'd rather them go slow, be patient, sell into run-ups. It's less dilutive to shareholders to sell into a run-up than to tank the price selling shares for 97 cents. Anyhow, I mean, things look pretty good for the rest of the year. I'm not forecasting any MOAS for AMC. I'm just looking for reasonable trade opportunities timed to corporate actions and the box office. And I'm bullish on the box office. I own 2 other companies in this industry, in this sector, because I'm bullish on the box office for this year. And so if things go well, that will positively affect AMC. I'm not saying positive like the price is going to soar to $5. Really what we want is no more dilution to raise cash, right? That's the minimum. And get all these damn lenders stop shorting our frickin' stock for hedging your consent fee shares and your exchangeable notes. Let's get all that 8K nonsense behind us and see the real price action. Let me see what the poll. I asked you guys in a poll, is Adam Aaron gonna, he's had some health problems. Is he gonna retire this year or hold on until next year? 63% of you said not this year. I don't know. I think he probably wants to go out on a as winning of a note as he can. So we'll see. Thank you for the reminder, Anya. OE says the note for equity exchange announced separately today adds further dilution overhang. I mean, it's pretty much they already gave the shares, 90% of them. There's what, 12 million shares of additional. But look, just figure 100 and whatever the number was, 140 million, 120 million shares, they're going out. You're going to see the shares outstanding go up to 740 million or something like that in the next few days or weeks. That's not dilution overhang. It is active dilution. It happened. It's done. Dilution overhang remaining is 111 million of old exchangeable notes with the 566 convert. $111 million. That is your remaining dilution overhang that I know of. Knifey says, how many years to get rid of the 8K nonsense? I mean, there's always going to be 8Ks. There were 2 that we were waiting on since March. Exchangeable notes. We got that today. 5 weeks later than I thought. And the 8K, we still haven't got it. And they're only halfway done. So, you know, that's good, actually. They did not need as much cash as I feared that they did in Q1. That is good. That is good. So take your time, Adam, on that other 8K. At least we got a check-in today. We know how many they sold and how many they have left to sell. After hours, AMC trading at 159, up almost 10% on the day. GameStop is at 24.16. They went up 1.5% today. I know a lot of y'all are wanting me to comment on GameStop. And I have been commenting a lot, a ton, nonstop since Friday, but in Discord only. And I will. We will talk about it on YouTube. I can tell you that, and so can anybody whose name is in a color here, who's in the Discord. Everything that happened to GameStop with the price going down was exactly what I said would happen in the Discord since Friday. and I will provide all the receipts for that. And there's a dozen people right now that would call me a liar if I'm lying to you. I know the hopium pushers on the YouTube channels covering GameStop told you you were going to the moon. That is not what I told my Discord on Friday or all weekend. And we went through all of the reasons why. Now, I don't think that the GameStop eBay thing is bad. It's not bad for GameStop. It's not bad for Ryan Cohen. It's just not what the hopium pushers are telling you. Yeah, and we saw Dr. Burry exit too. He's worried about the leverage. This is a lever up. It's a leveraged buyout or reverse merger. And if there's no if the execution falters, there could be problems. But the reason I'm not commenting on it a lot yet is because, everybody that's talking about it doesn't know what the fuck they're talking about. We haven't seen all the details. We don't have a firm commitment letter. eBay hasn't even accepted the offer. So why wag my jaw wasting your time with what? A bunch of theories? There's more details we need to see. But in general, we have a thought of how things were going to go. And in general, it went exactly as we thought. If you were in the Discord discussion in the GameStop room this weekend, you know what I'm talking about. And I'm not against GameStop buying eBay. Buy it. I think it'd be interesting to see. I did not see the Ryan Cohen on Charles Payne yet. I'm going to look at that momentarily. I was at a lunch at that time, so. All right, ladies and gentlemen, I'm going to go ahead and call this for here. Go hang out with the baby and the wife for a little bit. And as I get some free time tonight, I will watch the Ryan Cohen, Charles Payne interview and go through this 10Q in detail and get my thoughts out to you on video in the next day or so. Thank you so much. We love you. Have a good night.
We've been waiting for so long. Edgy's rain will soon be gone. A green candle up, a red candle down. By the dip, gotta hold our ground. Edgy's games are dead and gone. For the shorts, we're going long. If you down and sit and stare, if you love it, buy a share. A green candle up, a red candle down. By the dip, gotta hold our ground. We've been waiting for so long. Edgy's rain will soon be gone. A green candle up, a red candle down. By the dip, gotta hold our ground. Edgy's games are dead and gone. For the shorts, we're going long. If you down and sit and stare, if you love it, buy a share. A green candle up, a red candle down. By the dip, gotta hold our ground. We've been waiting for so long. Edgy's rain will soon be gone. A green candle up, a red candle down. By the dip, gotta hold our ground. Edgy's games are dead and gone. For the shorts, we're going long. If you down and sit and stare, if you love it, buy a share. Green candle up, and red candle down. By the dip, gotta hold our ground. Edgy's games are dead and gone. GameStop's rising, going strong. If you down and sit and stare, if you love it, show you care. A green candle up, a red candle down. By the dip, gotta hold our ground. We've been waiting for so long. Edgy's rain will soon be gone. A green